Welcome to the first video lecture. I'm using my iPad to record this video, so if you cannot hear me clearly or the slides are not clear, please give me a feedback. In this video, I'm going to talk about stock basics and common stocks. Recall from chapter 1 that the entire ownership stake of a corporation is divided into shares known as stocks. The collection of all outstanding shares of a corporation is called equity. And as you know, the owner of a share of stock is called a shareholder or stockholder. A public company has many shareholders and its shares are traded on a stock market. So investors can buy or sell the shares of a public firm on a stock market, and that's the main difference between a public company and a private company. So stock market provides liquidity for a company's shares and determine its share price. But what do I mean by liquidity here? Liquidity here means how easily an asset can be converted into cash. And by easily, I mean how fast and how cheap. So let's compare the stock market versus, uh, let's compare the stock market with real estate market to see the difference between liquidity of stock market and liquidity of a real estate market. Let's say you need cash and you own a house and you have decided to sell your house. If you want to sell your house, you probably cannot sell at your desired price within a short amount of time, let's say a day or two or even a week. If you really need the cash immediately, you have to sell your house at a discount, at a lower price than its fair market value. But now let's assume that you own shares of Apple or Google. Let's say you own shares of Apple. Apple is currently trading at 240, and if you need cash immediately, uh, you can sell your, you would be able to sell your stocks within seconds. And you don't really need to give a discount to the investors in the market in a normal trading day. Usually there is a bid-ask spread, and those bid-ask spreads are pretty narrow for liquid firms such as Apple. So the bid-ask spread, how narrow it is kind of an indicator of the liquidity. So for stock like Apple, usually the bid-ask spread is about 30 cents or 20 cents or even less. But there might be um, small companies with larger or their bid-ask spread. So if you don't know what is a bid-ask spread, let me quickly review for you. So bid price is the price that a market maker is going to buy a security from you at that price. Ask price is the price at which the market maker wants to sell a security to you. Okay, so the bid-ask spread is the difference between the ask price and the bid price. The last thing I want to mention in this slide is ticker symbol. A ticker symbol is a unique abbreviation assigned to a public company. So it's not available for private firms. As I said before, HEB is a large private company, but you cannot find a ticker symbol for HEB because it's a private company. But let's say Walmart, which is a public company, if you look it up on websites such as Yahoo Finance or Google Finance, you'll see for Walmart, the ticker symbol is WMT, or for Target is TGT. Okay. So let's talk about common stocks now. So in this chapter, we are going to see two types of stocks, common stocks and preferred stocks. I'm going to talk about preferred stocks in the next video. Shares of common stock represent ownership in the company. The common shareholders have two important rights. They have the right to any common dividends and they have the right to vote. So vote for what? For electing directors and for important events such as M&A or other important issues such as CEO compensation. So when they going to do that, when they usually vote, they can vote in an annual meeting. So if you want to see an example of shareholder annual meeting, I would suggest to go and watch an episode in The Office US edition. Okay, next I want to compare shareholders, common shareholders with bondholders. So common shareholders reap the benefit of a business success. There is no cap price of a share of stock. What do I mean by that? Let's say shares of Apple, they can increase when Apple investments are profitable. So if the sales of iPhones and iPads are higher than expected in a year, usually this Apple stock price increases, and that's normal for other companies as well. But shareholders are going to benefit from increase in the profit of the firm, and so this is a shared benefit with common shareholders, but bondholders will not benefit from the increase in the company's profit. Bondholders are going to receive coupon payments and the face value at maturity. So as you remember from chapter 6, let's say Apple has 1,000 face value bond which pays 8% on payments semi-annually. So the bondholders are going to receive $40 each 6 months and then 1,000 at the maturity as the face value and $40 again as the last coupon payment. So if there is an increase in the profits of Apple, the coupon payments to the bondholder will not be higher. It would be the same $40. But the common shareholders might receive higher dividends, or the stock price might increase. Okay, but on the other hand, if the company does not pay dividends to the shareholders, shareholders cannot force the company into bankruptcy. But bondholders, as soon as the company defaults on any coupon payments, they will act and take and force the firm into bankruptcy. So that's an important difference between the rights of shareholders and bondholders. And it's closely related to this term here, residual claim. So shareholders have a residual claim to the firm's asset. That means if a company goes bankrupt and liquidate its asset, the debt holders are going to be paid first, then preferred stock owners are going to be paid, and if anything remains, it will be paid to shareholders, common shareholders. Okay, so this residual claim is important here. In this slide, I'm just going to talk about different kind of votings for electing directors. So in this slide, my assumption is that there is only one vote per share, or one share, one vote. So we are going to compare straight versus cumulative voting for electing directors. In straight voting, shareholders vote for each director separately. Then the minority shareholders will lose at every vote, and they can have a representative on the board of directors because they cannot win the vote. However, in a cumulative voting, minority shareholders have a chance to elect their representative because each shareholder's total allocation of all directors is equal to the number of open director seats and the number of shares that that investor has or owns. Okay, so my point is, in a cumulative voting, minority shareholders have a chance to elect their representative. And that can be important for institutional investors which hold minority blocks in the firms. They want to make sure that they have a representative who can pursue their benefits and interests. Okay. So the things that I talked about in the previous share was based on one vote per share, but companies might have different type of common stocks. For example, they can have Class A and Class B. So usually the difference between classes is related to voting power. So Class A might have one vote per share, but Class B might have 10 votes per share. So another example is Google stock. So Google has three classes of assets: A, B, and C. So Class A has no voting power. Class B is not traded on stock market. It only belongs to the founders of Google and its managers. And then Class C, they have 1 vote per share. So in Class B, each stock has more than 1 vote per share. Okay, it's actually 10 votes per share. So let me write that down. So Class A for Google has no voting power. For Class B, there are 10 votes per share, and for Class C, there is 1 vote per share. Again, Class B is not traded on the market, but the ticker symbol for Class A is Google, and for Class C is Goog, G-O-O-G. Okay, so different classes might exist because the founder of the firm are still active and they want to hold their managerial position, or they want to make sure that they can elect the representative they want in the board of directors. Okay, so I'm going to uh, end this video right here, and then in the next video I'm going to talk about preferred stock. So in this video we just talk about stock basics and some features of common stocks.